I need you to understand something immediately because what has just happened in the silver market is not normal. It is not technical trading. It is not volatility. A line has been crossed. The global silver market has fractured in real time. And for the first time in decades, the paper price and the physical price are no longer telling the same story. Right now, as you watch this, there is a spread of nearly $10 per ounce between what silver is trading for in Western paper markets and what buyers are paying in Shanghai for real deliverable metal. That should never happen. In a functioning market, that is mathematically impossible. Why? Because of arbitrage. The moment a gap like that appears, the big banks usually swoop in. They buy the cheap silver in New York, fly it to Shanghai, sell it for the higher price, and pocket the difference. That action closes the gap. The rubber band snaps back. That is how the system is designed. But the rubber band isn't snapping back. It is stretching until it screams. The reason the banks aren't closing this gap is terrifyingly simple. The system has hit a wall. They cannot buy the cheap silver to move it because the metal simply is not there. The arbitrage is broken because the inventory is a ghost. This $10 gap is not a curiosity, it is a distress signal. It tells us that the Western spot price is now effectively a lie. It is a price for a contract, not a price for a bar. The Shanghai price is the real price because that is where the metal is actually changing hands. We are watching the separation of price and value live on screen. And if you hold physical silver, or if you are thinking about buying, you are standing at ground zero of a historic repricing event. The media will ignore this. They will tell you silver is range bound. They are looking at the paper chart. I am looking at the physical fracture. This information is dangerous to the status quo. The algorithm suppresses price manipulation content. We need to hit 1,000 likes to push this warning out. If you want to know what happens when the elastic band finally snaps, subscribe now. Let me be very clear because this is where most people get confused. You might be looking at your trading app right now and saying, but I can buy silver for $30. What gap is he talking about? Here is the uncomfortable truth. You aren't buying silver. You are buying a digital receipt. The silver trading cheaply in Western markets on the COMEX in New York or the ELMA in London exists largely as contracts, derivatives, and paper claims. It is a hologram. You can trade it instantly. You can leverage it 10 to 1. You can see it in your account. But when you try to take delivery, when you actually ask the bank to put the bars in a truck and send them to your driveway, that is where the problem begins. In the West, the game is fractional reserve. For every single ounce of real physical silver in the vault, there might be 100, 200, or even 300 paper ounces traded against it. It works exactly like a game of musical chairs. As long as the music plays and nobody asks for their metal, everyone feels rich. The price stays low because the supply of paper is infinite. You can print 1 million paper contracts in a second. You cannot print 1 million ounces of silver. But Shanghai is playing a different game. The silver trading at a massive premium in Shanghai represents real metal changing hands. They aren't speculators betting on the price direction. They are factories, utility companies, and government stockpiles that physically need the metal to keep the lights on. They don't want a receipt. You can't build a missile with a receipt. You can't coat a solar panel with a futures contract. They need the atoms, and that is why the price is higher. The paper price is the price of the hologram. The Shanghai price is the price of the real thing. And when the real buyers, the ones who need the metal to survive, start ignoring the paper price and bidding against each other directly, the entire illusion of the Western markets starts to dissolve. The hologram is flickering, and the people holding the paper receipts are about to find out that their silver was never really there. This brings us to the single most important economic concept for this entire crisis, the difference between want and need. In New York, traders buy silver because they want to make a profit. If the price drops, they get scared and sell. If the price goes too high, they take profits and sell. They are fickle, they are tourists. But in Shanghai, the buyers are different. They are industrial end users. They are the solar panel manufacturers, the electric vehicle battery plants, the defense contractors building guidance chips. They don't buy silver to flip it on a chart. They buy silver because without it, their product does not work.
Silver is the most conductive metal on Earth. There is no substitute. You cannot build a Tomahawk missile without silver.
Cannot build an iPhone without silver. You cannot build a solar grid without silver. This creates what economists call price inelasticity. Think about it. If you are Apple and you need a tiny bit of silver for every iPhone, do you care if silver is $30 or $100? No, because the silver is maybe $1 of the phone's cost. Even if it triples to $3, it barely dents your profit margin. But if you run out of silver, you have to shut down the entire billion-dollar factory. The cost of the metal is irrelevant. The cost of not having the metal is catastrophic. That is what the Shanghai price gap is telling us. The factories in the East are panicked. They are seeing the bottom of the barrel. So they are saying, we don't care what the COMEX says the price is. We will pay $5 over spot. We will pay $10 over spot. Just get the metal into our warehouse before the competitor gets it. They are bidding for survival. The investors in the West are playing poker with chips. The industrialists in the East are fighting for oxygen. And in a fight between a gambler and a suffocating man, the suffocating man will pay any price. For anyone over the age of 55, this should command your attention. You have seen this movie before. When the system is under pressure, it protects itself first. If you think, well, I have a contract, so they have to give me my silver, you are forgetting history. When the casino is about to lose, they don't pay out. They close the table. In periods of stress, paper assets behave very differently from physical assets. We saw this in 1980 with the Hunt brothers. When they tried to corner the silver market, the exchange didn't let the price run. They changed the rules overnight, implementing Silver Rule 7 to restrict buying and force selling. We saw it even more clearly in March 2022 with the nickel squeeze. When the price of nickel exploded and a major Chinese tycoon was about to go bankrupt, the London Metal Exchange didn't issue a margin call. They suspended trading. They literally turned off the computers. And then they did something unthinkable. They canceled billions of dollars of profitable trades. They rewrote history to save the bank. This is the force majeure trap. Deep in the fine print of every futures contract and every ETF, there is a clause. It says that if delivery becomes impossible due to market disruption, the exchange has the right to settle your contract in cash, not metal. So, you bought silver at $30, the real price goes to $100. You ask for your bars. They say, sorry, market disruption. Here is your $30 back, have a nice day. You get your fiat currency back exactly when that currency is becoming worthless. That is why the Shanghai gap matters. In Shanghai, the metal is leaving the vault. In New York, the metal is staying in the vault, and the paper holders are holding a lottery ticket that the organizers have already decided to cancel. Physical premiums have broken away from paper pricing. That is the warning shot. The moment the force majeure notices go out, the paper price of silver could theoretically go to zero, while the physical price goes to infinity. Because one is a broken promise, and the other is a strategic asset. What makes this moment even more dangerous is the timing. This fracture is happening at year end, during a period of thin liquidity when trading desks are lightly staffed and inventories are already stripped to the bone. There is no slack in the system. There is no secret warehouse full of surplus bars waiting to flood the market and save the banks. The $10 gap we see now is likely not the end state. It is the opening move. Now the skeptics will say, don't worry, if the price goes up, more supply will appear. That's how markets work. That is wishful thinking. Markets do not heal because we want them to. They heal when supply meets demand. And right now, silver cannot do that. Here is the supply trap that Wall Street ignores. 1. Mining is slow. You cannot spin up a new silver mine in a week. It takes 10 years to permit and build a mine. Even if silver goes to $100 tomorrow, that new supply won't hit the market until 2035. 2. Recycling is broken. Usually, when prices rise, people sell their grandmother's silverware. But in times of fear, the opposite happens. People hoard. Dealers are reporting that even as prices rise, less metal is coming back onto the market. Why? Because people don't want paper money anymore. They are holding on to the tangible asset because they feel the instability. So, we have a liquidity vacuum. Demand is exploding. Supply is frozen. And the arbitrage mechanism is broken. This is the perfect storm for a violent repricing. The elastic band isn't just going to snap back to $30, it is going to snap the other way entirely. We are only at the beginning of the story. The forces driving this divergence are structural, not emotional. They will not disappear just because a CNBC analyst says everything is fine. Markets do not heal by pretending, they heal through price and time. And silver is now entering the phase where the consequences begin to surface beyond the charts. The $10 Shanghai gap is the sound of a market breaking free from a model that no longer reflects reality. What happens next is rarely clean or polite. Once physical buyers start overriding paper benchmarks, the futures market becomes reactive instead of authoritative. That means the tail stops wagging the dog. We are going to see unusual behavior, refiners becoming cautious, delivery dates disappearing, and minimum order sizes skyrocketing. These are not glitches. They are the system tightening its grip to prevent total disorder. This is the trust discovery phase. Physical buyers trust their need, paper markets trust their liquidity. When those two clash, reality always wins. The prudent response to a moment like this is not panic, it is reassessment. You need to stop asking what is the price of silver and start asking, do I have access to silver? Because in a fractured market, those are two very different questions. The screen might say $30, but the dealer might say sold out. The price of an asset you cannot buy is effectively infinity. I know it's been frustrating. I know you've watched the price be smashed down every morning at 800 AM for years. You felt like you were fighting a ghost. You've questioned if you were wrong. You weren't wrong. You were just watching a rigged game before the rules broke. The $10 gap is your vindication. It is the market finally admitting that the emperor has no clothes. You didn't stack silver to get rich in fiat currency. You stacked it to have a chair when the music stopped. Well, look at Shanghai. The music just stopped. And while the rest of the world is scrambling to find a seat, you are already sitting down. Don't let the volatility shake you out now. You made it to the finish line. Don't drop the baton. So, watch the premiums, watch the delivery delays, ignore the noise of the paper price. The $10 gap is the clearest signal we have ever received. It tells us that the era of abundant cheap silver is mathematically over. History shows that markets eventually find equilibrium, but they do so through adjustment, not denial. The adjustment has started. Make sure you are on the right side of the dam when it breaks. Subscribe right now. We will be tracking the physical flows every single week as this crisis unfolds. Stay stacked, stay ready, class dismissed.